Hi, good afternoon. Thank you for joining us today for our Ready, Set, Retire presentation. My name is Jennifer Thompson. I'm a benefits educator with ERS. Now, this presentation is going to be for state employees that are in groups 1, 2, 3, and 4. So if you work for a higher education institution, this might not be the right presentation for you. We have a presentation that is specifically for higher education institution employees. We have the recording on our YouTube channel. We have the PDF available on our website. So if you're not a state agency employee, you might want to check those out. So we'll go ahead and get started and go over what we're going to talk about today. And we are going to talk about the different retirement groups. So if you're not sure what group you're in, we'll go over those different groups. We'll talk about what service helps you meet your retirement eligibility, your monthly retirement payment, which is also known as your annuity. We'll talk about how your insurance benefits work in retirement, what happens if you return to work, what happens if you leave state employment before retirement? And then we'll go over the actual steps. If you're ready, what do I actually need to do? We'll talk about applying for retirement, and then we'll provide more resources that are available to you. So these are the different groups. If you're not sure what group you're in, you want to make a note of this. Ability rules and annuity calculations are different for each group. So this group is determined by the date you started working for a Texas agency. So for group 1, those are going to be for those of you that started before September 1st, 2009. Group 2 is going to be for those that started September 1st, 2009 through August 31st, 2013. Group 3 is going to be for those that started September 1st, 2013 through August 31st, 2022. And finally, we have group 4, and that's going to be for those of you that started September 1st, 2022 or later. Now, sometimes we have some people that work for a state agency and then they might leave and come back to working for the state. Now, if you previously left state employment and you withdrew your retirement contributions, you're not going to go back to your previous group when you return. You're going to be in whatever new group, whatever that date is. But if you did leave that money in that account, you didn't withdraw it, when you return back to work for a state agency, you're going to stay in that original group. So just make sure you know what group you're in and what rules apply for you whenever I go through them. Okay, so now we're going to talk about your income at retirement. And when you think about retirement, it's really important to think about your financial position. So most financial advisors say you'll need about 80% of your pre-retirement income to comfortably maintain your current lifestyle after retirement. So we like to think of this as a three-legged stool. You can see the picture here. We have the three legs. Those three legs are going to be your ERS annuity or your pension, your Social Security benefits, and your personal savings. So that could be Texas Saver 401k or 457 account. It could also be other personal savings. Now, if you're eligible to retire before you can start getting those benefits, either from your Texas Saver account or start drawing Social Security, you want to think about, is that pension alone going to be enough to cover your expenses, or are you going to need to supplement your income with the job? So that's really the first thing you want to think about is, can I afford to retire? And one thing we like to tell people is the earlier the better to start planning, but you can schedule an appointment, a retirement readiness review with one of our Texas Saver retirement plan advisors like Antonio. And you can really have some help with that and think about, are you able to afford to retire? What changes do you need to make in order to be able to retire? So let's talk more about that first leg of the stool. And that first leg is going to be your ERS annuity. And the great thing about working for the state is your ERS annuity is paid to you for your lifetime. So this isn't very common anymore where you have a pension where you get a lifetime payment. Now, currently the average state employee retires with about 22 years of service and an average gross standard annuity amount of a little over $1,800 monthly. Now, that's not including taxes or other deductions. So for groups 1, 2, and 3, your annuity is determined by your years of service and your highest average salary. So the longer you work, the higher your annuity will be. Now for group 4, it works a little bit different, but your annuity is based on your account balance and ERS's investment earnings. Now your annuity is paid the last business day of each month after you retire. And you can create your own annuity estimate at any time by logging into your ERS online account. So even if you have a long time to go, before your retirement, go ahead and create that estimate so that you can have an idea of what your retirement might look like at different dates. And you can play around with the dates and see what might work best for you. Now, no matter what group you're in, the longer you work, the higher your annuity will be. Okay, so the second leg of that three-legged stool is going to be your Social Security benefit. Now, Social Security benefits don't reduce your ERS annuity, and the earliest that you can draw those benefits is age 62. Now, that is considered early retirement under the SSA standards, and you want to contact them to find out what age you can draw your maximum Social Security benefits. So for more information, you would want to call them at 800-772-1213. And I think you can also go onto their website and create an estimate through them. So you might want to check into that also. Now, the third leg of that stool is going to be your personal savings. So that could be a Texas Saver 401k or 457 account. It might be an individual retirement account or an IRA that you might already have. Could also be a retirement account from a previous employer. We have some people that were previously military and they have their military retirement or a teacher retirement. But your personal savings does play an important role in your financial stability. So if you aren't already, you might want to consider investing in a Texas Saver 401k or 457 account or some other type of retirement account. Now, if you already have a personal savings account like an IRA or a retirement account with a previous employer, you can contact a Texas Saver representative like Antonio, and he'll talk about who you can contact that's in your area to discuss. You cannot transfer your TRS service to ERS to reach ERS eligibility or increase your annuity, but you can use your TRS service as PRP credit to reach eligibility with ERS. So your retirement check from ERS would be based on your ERS service credit only, and you would need to contact TRS to find out if you're eligible for a retirement annuity with them. Now, there's also optional retirement program, or ORP. That's an option for higher education employees who chose not to contribute to TRS. So, like PRP service, ORP service credit helps state agency employees in groups 1, 2, or 3 meet the rule of 80 sooner and help meet retirement eligibility. Now, that can be used towards insurance eligibility as long as you haven't refunded your ORP account that you're eligible to draw from. So you have to have money in that account in order to draw from. Now, Group 4 members cannot apply ORP service credit to reach retirement eligibility or increase their annuity. So withdrawn or refunded service credit. So I mentioned before, if you've worked for the state in the past and you withdrew your retirement account and then you return to work for the state, you're not going to go back to that original group that you were in, but you can purchase or certify all or some of the service that was refunded to you. So when members of groups 1, 2, or 3 purchase, withdrawn, or refunded service credit, it counts towards their eligibility to retire. So they can retire sooner with an annuity and retiree insurance. Now, again, members would be eligible for retiree insurance, medical insurance at age 65, or if they meet the rule of 80. It also increases their annuity by increasing the service credit in the annuity calculations, which we'll talk about in a minute. Members of Group 4 can also purchase withdrawn or refunded service credit to retire sooner with an annuity and retiree insurance. Purchasing withdrawn or refunded service also increases their annuity by increasing the balance in their retirement account. And whichever group you're in, if you're thinking about purchasing withdrawn or refunded service, you should do it as soon as possible. For groups 1, 2, and 3, the cost of purchasing that increases 10% every year on September 1st. This is to help make up for the compounded interest the money would have earned if it had stayed in your account. And for group 4, you'll be paying your current retirement account just the amount of money you withdrew without any unrealized interest earnings factored in. But the sooner the withdrawn money goes into your group 4 account, the sooner it will start earning interest that will be compounded over the rest of your career. Members of Group 4 also have the option to simply certify their withdrawn or refunded service without purchasing this. This will count only towards your eligibility to retire with annuity. So it won't count towards your eligibility for retiree insurance, and it's not going to increase your annuity amount. Now, ERS strongly advises against just reaching retirement eligibility sooner without increasing your retirement account balance. If you did that, it might mean that you retire with a small monthly annuity amount that doesn't meet your needs. And that can make it even harder financially if you're not eligible for retiree insurance. So that's something you want to think about before you do that. Okay, so for groups 1, 2, and 3, if you served in the military, you can purchase up to 60 months of active duty service as long as you aren't eligible for military retirement based on 20 years of service. You would need to send ERS a copy of your military record, either DD-214 or NGB-23. Your military discharge must be honorable. Service in the reserves is not eligible for purchase. In order for your military service to be used for your retirement, you will need to have at least 5 years of service credit. Now, the cost of that military service also increases by 10% every year on September 1st. If you were hired between September 1st, 2003 and August 31st of 2014, you had a waiting period before you started contributing to your retirement account with the state. So the length of that waiting period depends on when you were hired. So if you wanted to purchase that, you could do that. Now, after you've purchased all of your available service and you have 10 years of eligible service credit, not including any purchased military or unused sick or unused annual leave, you could purchase up to 3 years of additional service credit. Additional service credit has to be purchased in 1-year increments unless you need a specific number of months to meet your eligibility and apply for retirement. The cost of the waiting period and the additional service credit is based on your years of service, your age, salary, and actuarial factors. Now, because of this, that cost does change every year on your birthday. So that's why we say the sooner that you do it, the cheaper it'll probably be. If you are just wondering if you want to know how much it costs to purchase that service, including any withdrawn or refunded service, you could request a service purchase coupon online. Now, we can only email a coupon to the email address that you have on file. So if you haven't updated that, update that through your ERS online account. If you don't have online access, you can always call our customer service department to request a coupon. Now, don't worry, you don't have to purchase the service if you decide that you don't want to, but if you just want to know how much that is, you can request that. So you have different payment options if you choose to purchase it. You can pay for that with a personal check or a money order. You can roll over funds from your Texa Saver 401k or 457 plan or another eligible pre-tax account. If you want to do that, you would need to call ERS to start the rollover. Or you could do a partial rollover and pay the rest with a check or a money order. Now, you do have to purchase that service before you retire. So on the next couple of slides, we're going to discuss your annuity. Now, remember I mentioned before, this is a benefit that's paid for your lifetime once you're retired, and it's paid on the last business day of the month. Now, when you retire, your monthly annuity check is paid to you from your retirement account. And when your account no longer has funds, you're going to continue to receive a monthly annuity check that's paid to you from the state's funds and investments earnings for the rest of your life. So this formula is authorized by the Texas legislature. For regular service employees, we multiply your highest average salary by your service percentage to get your gross standard annuity amount. Now, depending on which group you're in, that will depend on how many months. So your highest average salary is the average of the highest 36 months for Group 1 employees, 48 months for Group 2 employees, and 60 months for Group 3 employees. Your monthly salary does include base pay, longevity pay, and, if applicable, hazardous duty pay and benefit replacement pay. Now, overtime pay, comp time pay, and one-time merit bonuses are not included when we calculate your highest average salary. To get your service percentage, we multiply your years and months of service by 2.3%. So if you want to see the service multiplier table, you can find that on page 31 of the Planning Your Retirement booklet. If you're not familiar with the Planning Your Retirement booklet, it's a really good resource. It has all of your specific details. You can find that by going to our website, ers.texas.gov. And the easiest way to find it is on the search bar, type in PYR, and it'll pull up on that result. So those of you that are in Group 1, you do not have an age-based annuity reduction. So that means that someone in Group 1 can retire at the age of 58 by meeting the rule of 80, and they would receive their full annuity benefit. Group 2 members have a 5% reduction in their annuity for every year they retire before the age of 60, and there is a 25% cap, so it's not going to be reduced more than 25%. Just an example, if someone in that group decides to retire at 58, that's 2 years before the age of 60, so they would have a 10% reduction in their annuity calculations. Now, Group 3 members would have a 5% reduction for every year that they retire before the age of 62, but with that, there's no cap. So that means that if a Group 3 member decides to retire at the age of 55, they would have a 35% reduction in their annuity calculation. Now, for Group 4, there's no specific age reduction, but retirement benefits may be lower based on the member's age at retirement. And one question we get asked a lot is that reduction going to be just until you reach that age? And the answer is no, that's a permanent reduction for the rest of your life. So that's something also to be aware of and to think about. So for Group 4, the Group 4 retirement benefit is what's known as a cash balance benefit because the amount of the monthly annuity is based on the amount of money in an employee's account at the time they retire plus a match from the state. So it works a little bit different from Groups 1, 2, and 3. Just like Groups 1, 2, and 3, Group 4 employees contribute a percentage of their salary to their ERS retirement account every month that they work for a state agency. But the balance in their account when they retire doesn't include just their contributions. It includes a guaranteed 4% interest that's earned every year, and in years when ERS's investments have done well, additional interest called gain share. The 4% guaranteed interest in any gain share compounded over the employee's career to help the account balance grow. Then, when that employee is eligible and ready to retire, ERS adds 150% match that's funded from the state's annual 10% contributions over the employee's career. Now, one thing we can't forget about is deductions. Your annuity is taxable, so federal income taxes are deducted. Now, you're not going to pay Social Security or Medicare, also called FICA taxes, on your annuity payment as it's not considered earned income wages. In addition, if you're not grandfathered for tiered retiree insurance, you will be required to pay a portion of your retiree health insurance, or if you cover your eligible dependents. We have that question a lot. Can I still have my spouse on my insurance? Or if they weren't on my insurance when I was working, can they still be added? And you can still add eligible dependents as long as you're eligible for insurance, but you would have their premium to pay. So that would be deducted from your annuity along with the tobacco user premium if that's applicable. You could also still choose to enroll in optional coverages like dental, vision, optional life, dependent life. Those premiums would also come out of your annuity. Now, if you decided to return to active employment elsewhere, Social Security and Medicare taxes are deducted from your salary because that income is considered earned income wages. Okay, so when you're ready to retire, you do have 6 payment options that you can choose from. So depending on which option you choose, that will depend on how it affects your beneficiary once you pass away. The option you choose can only be changed in certain situations. So let's go over the different options. Now, the first is the standard annuity option. This is going to provide you your highest monthly lifetime payments. Those payments are not going to continue after your death. But if there is still money in your account, then your survivor receives a one-time payment. And you can designate one or more beneficiaries with this. Now, we said that you will receive a payment for the rest of your life. If you choose one of the next options, options 1, 2, or 5, well, any of the survivor options, I'll go over 3 and 4 on the next slide, but your survivor will also get a payment for the rest of their lives. So for options 1, 2, and 5, they do lower your annuity for your lifetime, but after you die, your beneficiary would receive a percentage of your gross annuity amount for their lifetime. Now, with these 3 options, you can only choose one beneficiary. So option 1 pays your beneficiary up to 100%. Option 2, 50%, and option 5, up to 75% of your gross annuity check. Now, if you choose option 1 or 5 and your beneficiary isn't your spouse, so maybe a child, for example, the amount of the annuity could be reduced based on the age difference. Now, with these 3 survivor options, if your beneficiary dies before you, your annuity would increase back to the highest standard annuity amount for the rest of your life. So if that does happen, if your beneficiary does die before you, please call ERS as soon as possible so we can make that change. And you wouldn't have the option to name a new beneficiary, but you can start getting the standard annuity once we make that adjustment. Now, the other 2 options are options 3 and 4. They work a little bit different. Now, with these options, your lifetime annuity is still reduced, but your beneficiary is paid only if you die in the first 5 or 10 years after you retire. So option 3 is going to be 5 years, and option 4 is going to be 10 years. With these 2 options, you can designate one or more beneficiaries. Now, with option 3, your beneficiary would receive the remainder of 60 monthly payments. And option 4, your beneficiary would receive the remainder of 120 monthly payments. Now, that 60 and 120 payments are from the date you retire, not from the time of your death. So another thing to consider when you're going to retire is whether or not you want to take a PLSO, or a partial lump sum option. That is where you can choose to get a one-time payment that's equal to 1 to 36 months of your standard annuity payment, That's paid to you as a lump sum about 5 business days after your first retirement check. Now, if you decide to take this, a PLSO, your monthly annuity is permanently paid directly to you. It would be taxed at 20%. And if you retire from state employment younger than age 50, you may have an additional 10% penalty when you file your taxes. So if you wanted to avoid or decrease the tax and penalty, you could choose to roll over some or all of it to a Texas Saver 401k or 457 account or a personal pre-tax account that you have. Now, if you are in groups 2 or 3 and you retire with an age-based reduction, you wouldn't be eligible to take a PLSO at the time of your retirement. And that decision of whether or not you want to take a PLSO can't be changed once you've retired. So that's something you will want to know when you call to process your retirement. Okay, so I mentioned this a little bit, but we're going to go over your benefits in retirement. Now, one thing, the state currently provides valuable benefits to retirees just as it does for active employees. It is important to understand, though, that health and other insurance benefits for employees and retirees are subject to change based on available state funding. The Texas legislature sets the level of funding for such benefits and has no continuing obligation to provide those benefits beyond each fiscal year. So I mentioned before that you have to have at least 10 years of eligible service credit in order to be eligible for insurance at retirement. Now, how much you pay for that insurance depends on when you started working, how long you worked, and if you retire from full-time or part-time employment. So if you retire from full-time employment and you have the minimum of 10 years, up to 14 years and 11 months of eligible service credit, the state will contribute 50% of your premium. So you would pay for the remaining 50%. Now, you could still have your dependents on your insurance, and it would be half of these amounts. So the state would contribute 25% towards your dependents premium, and you would be responsible for the remaining 75%. Now, if you have 15 years to 19 years and 11 months of eligible service credit, the state will pay 75% of your premium and you would be responsible for the remaining 25%. And if you have 20 or more years of eligible service credit, or you had 5 or more years of GVP participation on September 1st, 2014, then the state will pay 100% of your premium and half of that for your eligible dependents. Now remember, as full-time employees, the state pays 100% of our premium and 50% of our dependents premium. So that's something, to be aware of and to think about. Just because you're eligible for insurance doesn't mean that it's going to continue to be paid at 100%. Now, if you do retire from part-time employment, the state will pay half of these amounts for those retirees that worked part-time before retiring. Okay, so now we're going to look at the difference between active employee benefits and retiree benefits. We get this question a lot. What changes? What is the same? This is a handy little chart that shows you. So after your retirement has been processed and your retiree insurance has been set up with ERS, you're going to receive a retiree insurance enrollment statement, and it's going to show the coverage that you're enrolled in and give you all of your options. Now, you're going to have 30 days after your retirement date to elect or make any changes to your benefits. After that, you'll have to wait until your enrollment period, or if you have a qualifying life event like a marriage or divorce, or you have a new baby or adopt a baby, that would be considered a qualifying life events, to enroll or make any changes to your benefits. Now, as a retiree, you can drop any insurance at any time, but if you wanted to re-enroll, you'd have to wait until that enrollment period. So let's look at the chart here. For health insurance, depending on your eligibility, if you're retiring for full-time or part-time, we went over the different percentages on how much you would pay. Now, as an active employee, you have your health insurance options, whether you choose Health Selective Texas or Consumer Directed Health Select. You have the medical plus prescription and $5,000 of basic term life. As a retiree, depending on whether you're enrolled in Medicare or not, that determines your health insurance. Now, if you are wondering about that, we don't go into that a whole lot. I have the next few slides about it, but we have a presentation about that. But just know in retirement, as long as you're eligible, you have health insurance options that includes medical, includes prescription drug benefits, and that $5,000 basic term life does go to $2,500 basic term life. Now, you can still choose to enroll in your optional coverages. So if you still want to be enrolled in dental or vision, you can still choose to enroll in that. It's the same coverage, same premium as when you're an active employee, so that doesn't change. Your optional term life, if you retire as a contributing member and you're already enrolled in elections 1 or 2, that election can carry over into retirement. Now, if you're already enrolled and you're enrolled in elections 3 or 4, when you retire, that would reduce to election 2. Now, in retirement, you wouldn't have the option to sign up for short and long-term disability or accidental death and dismemberment. And for Tex Flex, that comes from your paycheck. So you wouldn't be able to continue unless you participate through Cobra, but that could only be through the same plan year. And those contributions would be after tax contributions that you would need to send directly to ERS with a check or money order. So you do have the option to stop your enrollment in Tex Flex during summer enrollment prior to your retirement date. Now, one thing I want to make sure to mention here is if you have a Texas Saver 401k or 457 account, you can still access those services after you retire. You just wouldn't be able to contribute to your account through your regular contributions because that normally comes from your paycheck. But you can still set up those no-cost appointment with the retirement plan advisors like Antonio and get advice on how you should make those withdrawals. When you need to start taking those withdrawals, take advantage of those appointments there for you. Now, at retirement, you will have that 30-day window to elect or make any changes, and then you can make changes either during annual enrollment or with a qualifying life event. Medicare and your state health insurance. Once you are retired, you'll want to sign up for Medicare Part A and Part B about 2 or 3 months before your 65th birthday or when you're first eligible due to a disability. It is important to sign up for Medicare because your state coverage won't be primary once you're retired and 65. So sometimes people do ask, well, do I have to? And okay, technically you don't, but you would be responsible for the 80% that Medicare would have covered. So it's usually a good idea. Now, after you do have your Medicare card, you want to contact DRS, give us your Medicare information so that we can enroll you in our Health Select Medicare Advantage and Health Select Medicare RX. You could choose to opt out of that if you wanted and keep Health Select secondary, but remember this benefit will pay secondary to Medicare. Now, if you plan to work past the age of 65, you don't have to sign up for Part B until you retire. It is a good idea to contact Medicare and just let them know you're not signing up for Part B because you're still working. Then once you decide to retire, you'll want to contact Medicare about 2 to 3 months before your retirement date and sign up for Medicare Part B. Now that just gives you a little sneak peek into Medicare. We have a whole presentation called Medicare Preparation. We do those webinars. There's some already scheduled on our events calendar. We also have that presentation recorded on our YouTube channel, and you can find the PDF on our website. So if you're interested in learning more about that, we encourage you to sign up for that presentation. Let's talk about what happens if you do decide to leave work for the state before you retire. Now, the first question is, why would you want to do that? We all know we have great benefits working for the state, and we've talked about the different ways that you can meet retirement eligibility when you're retiring directly from the state. But, some people do decide to leave state employment before you're eligible to retire. Although many do wait until they're vested in ERS retirement. A lot of people wonder what that means, being vested. That just means that you are guaranteed an annuity when you become eligible and choose to retire. So you could stop working for the state and not actually retire, where you start drawing your annuity. Now, groups 2 and 3 become vested with 10 years of state service. Groups 1 and 4 are considered vested with 5 years of state service. But remember, all groups still need 10 years of service to be eligible for that health insurance in retirement. Now, we all know there's a lot of benefits. We hear about it, our great insurance. We have a lot of benefits of working for the state, but I just want to tell you a few of them again, just in case you are considering not working for the state until retirement. So, one of them, I mentioned it before, but we have excellent health insurance coverage, and the state pays 100% of our premium while we're working. So, health insurance is so important. You never know when you're going to get sick, and that's such a great benefit. We also have the other insurance coverages such as dental, life. We have all of those optional benefits. One thing that I personally have taken advantage of lately, if you're not familiar, we have a Well on Target plan where you can join Well on Target and you get access to thousands of gyms. I'm going to a really fancy gym and not having to pay the price of it by having our health insurance. And so for me, that's a great benefit because I take advantage of it almost every day. So I love it. Look into that if you haven't already or if you're not familiar with it. You also get a higher annuity that's based on more service credit for groups 1, 2, and 3, and continued individual and state contributions for group 4. For groups 1, 2, and 3, if you're still working for the state, you have the opportunity to apply that unused sick and annual leave to your annuity calculation. So if you're not working for the state, you don't get that benefit. You also wouldn't have a break in your ERS health insurance when you retire, if you retire directly from state service. And you also have the opportunity to increase the state contribution to your retiree health insurance premium. So if you don't meet that 2014 deadline for a 100% contribution, that's something to think about. Remember, you need 10 years to have insurance, but how much will that cost you, in the long run if you're having to pay 50 or 25% of your premium? Those are things that can really pay off in the long run, sticking around. And I also want to say on this slide, some people think you have Texa insurance or the comptroller insurance, and you don't. We cover the insurance and retirement benefits for all state agency employees. So just because, maybe you don't like your agency, maybe it's not a good fit. I worked for another state agency before I worked for ERS, and I couldn't be happier based on the move. So if you are thinking about leaving your job, look at other state agency jobs and see if you can find something that might be a better fit. I said all of that, but the next thing I want to talk about is if you do decide to leave the state before you retire, another thing that you might want to think about is whether or not to keep that money in your ERS account versus withdrawing it. So if you decide to leave employment, you could decide to leave the retirement funds ERS, and if you do, and if you're vested, you can get a lifetime monthly annuity once you do reach retirement eligibility. So if you have at least 10 years of service, you'll also be eligible for that retiree health insurance and other GBP benefits, but you'll have that 60-day health insurance waiting period following your retirement date. Now, you do have to contact ERS to retire when you become eligible, and I'll talk about that more in a minute. Now, if you return to state employment and you still have that ERS retirement account, so you don't take the money out of that account, you're going to be able to stay in that same retirement group that you were in when you left state employment. You'll also have the same service credit as before that will apply towards your eligibility for your lifetime annuity and retiree insurance. And if you weren't vested or eligible for retiree insurance when you left the state, when you return to employment, as long as you kept that money in the account, that's a good way to finish what you started and get vested and get those 10 years that's currently required for retiree health insurance. So what happens if you withdraw that money from the account? If you withdraw it, you'll get your contributions, not the state's contributions, plus annual interest earnings on your contributions. So for groups 1, 2, and 3, the interest is 2%. Interest for group 4 is 4%, plus any gain share interest earnings. Now, if you return to state employment after withdrawing your ERS retirement account, you're going to be in group 4. So no matter which retirement group you were in before you left, if you take that money out, you're coming back as whatever the newest group is. Right now it's group 4. So group 4 members can purchase their withdrawn service credit to reach eligibility for retirement annuity and retiree health insurance sooner. And you will not be able to purchase military, waiting period, or additional service credit. You can also certify your withdrawn service without purchasing it to reach retirement eligibility. Now, I mentioned before, ERS doesn't recommend doing this. I think the moral of the story is we want to all stay with the state and keep our retirement account in ERS and get a lifetime payment like we're all entitled to. So I'm going to talk about the actual steps to apply for retirement. So what do you need to do? The first thing you want to know when your eligibility date is. So what is the date that you're first eligible to retire? You should keep those dates for your annuity and your retiree insurance in mind. We do send contributing members, so members who are still working for a state agency, a statement of retirement benefits every year. It's usually about 4 to 6 weeks after your birthday. You can get that in the mail. Now, we do send non-contributing members, so those who have left state employment but didn't withdraw their ERS retirement account, a letter about every 2 years. But if we don't notify you specifically when you become eligible to retire. Now, you should also know and understand how delaying retirement could impact your annuity, like we talked about in the annuity section. So if you're still working for the state when you become eligible, delaying is going to increase your annuity. Remember, we said the longer you work, the higher that could be. So if you get a higher state contribution to your health insurance, the longer you work, maybe you're right at 18 years and you have 2 more years to reach that 20 years and get 100% of your premium paid, that's something to think about. Is it worth it to work those 2 years and have 100% contribution for your retiree insurance? Now, if you're no longer working for the state when you're eligible to retire, it might be best to go ahead and start drawing your annuity as soon as you become eligible, especially if you're 60 or older in group 2 or 62 or older in group 3. Because for groups 2 or 3, delaying that retirement is not going to increase your annuity unless you're under those age thresholds. If you're in group 4, your annuity amount would continue to grow if you delay retirement because your account is still going to be earning 4 to 7% interest every year. So the age at which you retire is always a factor in group 4 annuity calculations. But it might be worth it to start getting an annuity as soon as you can, depending on the amount of the annuity and your age. So the first step, you want to have a date in mind, the 3 steps to retirement. The first thing is to create a retirement estimate. You want to have a date in mind of when you want to retire. I mentioned before, your ERS online account is really helpful for creating those estimates. You can put in different dates and see what the difference might be and see, if you wait 1 or 2 more years, how much more is it going to be? Do you really want to do that or need to do that? Once you have a date in mind, you can call us to go ahead and apply and process that retirement. Now, you can't call more than 90 days in advance. But within about a month or two of your planned retirement date, you can go ahead and start that process. We're going to send you a packet with the documents and paperwork. The third step is going to be to return all of those documents on time. Now, if you're still working for the state when you retire, you want to make sure to tell your agency that you're retiring. We don't share that information. We're not calling them up and saying, hey, John wants to retire. We're not going to tell them. Just make sure that you tell them that you're retiring. We don't want any delays in your retirement. We want to make sure that all the paperwork is completed and everything goes well. So sometimes people do decide to return to work after they've retired. Now, if you're returning to a private sector job, there's no waiting period. If you do plan to return to work for the state, you do have to be retired for at least 90 days, and you can't have a prior agreement with your employer to return to your job. Now, if you do return to work for the state, you can choose active employee benefits. That's going to give you the option to enroll in those things that are not available to retirees, like the Texas Income Protection, short-term and long-term disability insurance, TexFlex, and also the life insurance options that aren't available to retirees. Now, if you're working, you're not able to stay on the Medicare Advantage plan, which does include prescription drug coverage through Health Select Medicare RX. So if you do return to work for the state, you'll be enrolled in the non-Medicare plan. Now, if you do return to work for the state, you're not going to be contributing to your ERS pension fund. So you won't increase your ERS pension by returning to work. But you could choose to start contributing again to your Texas Saver account. So that could help increase your personal retirement savings and maybe help you out on your federal income taxes because that lowers your taxable income. So that's something that some people have said they really love to take advantage of. Now, another thing, if you're not already familiar with it, you really should be, is our discount purchase program. I've used this and my coworkers have used this, and you really do save money. So this is where you can go online, you can buy products and services. They have appliances, vacation packages, flights, cruises, all kinds of things. You can use this now and in retirement. So just go to the website, you create a login and password. There's no membership fee or anything. If you've already created an account, you want to make sure and create an account with your personal email address. That way you can continue using that and taking advantage of those discounts. Now, one other thing we like to mention is you want to make sure to designate your beneficiaries. It's important to select the people that will receive your retirement account and life insurance benefits in the event of your death. So you want to check on that as often as you can, make sure it's updated. For state of Texas employees, once you have 10 years of service credit, you do qualify for the death benefit plan, which allows you to choose how your beneficiary will receive your retirement account balance in the event of your passing. So you would be able to choose one of four options. You could choose beneficiary's choice, so that means you leave it up to them to choose a life annuity, a lump sum payment, or a 10-year guaranteed annuity. You could choose the life annuity, so your beneficiary would receive a monthly annuity payment for the rest of their life. You could choose the lump sum payout, so your beneficiary would receive a refund of your retirement contributions in a lump sum minus any taxes. And you could also choose a 10-year guaranteed annuity, so your beneficiary would be paid an annuity once a month for 10 years. The beneficiary designation for your ERS retirement account and your life insurance, it is a multi-step process. You have to sign in and designate that, and then you have to print the form, sign and mail back the form. And your beneficiary designation for each program isn't complete until you do print, sign, and mail back that form. So if it says form pending, that means it's not complete. Make sure, just try that again. Make sure we get your beneficiaries updated. Now, if you have a Texas Saver account, you'll also need to update your beneficiaries for that. So you'll need to download a form from the Empower website and return that form to Empower. You can update these beneficiaries at any time, but if you get married or divorced, you have children, you want to make sure that you do update those. Okay, so I've gone over a lot of information. You have a lot of resources that are available to you. The best place for our resources is going to be our website. It's ers.texas.gov. That's where you can view that ERS online account. You can update your beneficiaries, update your contact information. We also have our events calendar where we have those Medicare preparation webinars. Coming up this summer, we're going to be going out across the state to our summer enrollment fairs. If you see anything on that events calendar and it's in your area, you're welcome to join us. We also might have retirement presentations that are in your area. If they're on that calendar, please feel free to come and join us. We also have ERS publications, so you could sign up for Retiree newsletter, your ERS connection. You can view that online. And then you can subscribe to any updates. Our website also has links to all of our plan administrator websites. So if you can't remember exactly what the dental company is now, you can always go to ers.texas.gov and go to the link. It's Delta Dental, by the way. You can also call us toll free 877-275-4377. And we're available Monday through Friday, 8 a.m. to 5 p.m. Central Time. You can also check out our Facebook page. We have updates. You can tell us how great your retirement is, how an event was, or read posts from our plan administrators. We also have that YouTube channel that I mentioned where you can watch our videos about your benefits. And we also have retirement and Medicare videos on there also. Okay, so I want to thank you all today for joining. So we do have Antonio Rivera, so he can give you more information about Texas Saver,
Good afternoon, everyone. My name is Antonio. I'm one of the retirement plan advisors for the state of Texas, the Texa program. Who we are, we're financial advisors here for you only. We're exclusive to the state of Texas employees. So we help employees of the state plan to retire well and retire comfortably and with confidence. So what we do day to day is we sit down with employees of the state. We'll look at your specific goals and plans to help you accomplish those, and we'll educate you on how the accounts function, what are the benefits and highlights, of course, that you'll do it on any day throughout your career, but also how the accounts function when you finally retire. In the process, we're going to educate you on the contribution, making sure that you're contributing properly to help you accomplish those income goals when you finally retire. And the better part of that whole conversation is making sure that we're investing the money right. So you have a 401k. It's great that you understand what is a 401k, how does it function, what are the pros, what are the cons, and what is the things that you need to understand about that account, and also the 457. Saving the right money. Are we saving the right kind of money? It's specifically something we get asked all the time. I'm doing pre-tax. I'm looking at buying time in the future with the state of Texas, like Jennifer went over. And then we look at making sure we're adding the right amount of pre-tax money. We can also add a Roth to the account. So Roth contributions that has a great benefit, as many people know. If you want to learn more what Roth can do for you, please set a meeting with one of us. We'll educate you what Roth is, how it functions, and what are the requirements to make sure your gains become tax free. But the investment piece, to me, is the most important thing. Why? Is because you can have the right account, you can add the right kind of money, but if your investments are completely wrong, you will not accomplish what you want. So one thing I want to emphasize today is going onto the portal and looking at your account. Understanding your portal is going to be so important, helping you accomplish those goals, and we'll be working with you to help you accomplish those goals and giving you that education. So if you go to texterra.com, you will see your Texterra portal. So first things first, you all want to register. So click on register if you've not done so before. It's going to ask for your information. From this step here, next, it's going to ask you for who do you want, or what do you want your username to be. You're going to create your username. It's going to verify who you are, and then you're going to get access to your portal to look at your account. Inside the portal, you can do pretty much everything. You can change your contributions, you can change your investments, you can change the kind of money you're adding to the account, and look at your transactions. You can look at your deposits and many other things that your account may be doing on a day-to-day basis. The only thing right now that we're working on changing is your beneficiaries. Right now, beneficiaries are changed only through a paper form, and that can be found here on takesera.com, and I'll show you where it's located. So you just click on this link right here. Let's say it's a 401k that you have with us. Click over here to 401k forms, and here you'll find the beneficiary form. And same thing for the 457. It's going to be the same exact process, making sure you're updating your beneficiaries whenever they need to be updated. People get married, people get divorced, people have kids, whatever reason it is. But I'm going to tell you right now, out of 10 people that I see in a day, I will say about 8 of them do not have beneficiaries because they're either never set up, we've never received their form, or they're just incorrect. They're out of date. But the Textual Portal is going to be, it's a great resource that you're going to find here. One thing I'm going to show you really quick is how to schedule a meeting, because what we do, like I mentioned, is we have individual meetings. All your meetings with us are going to be at no cost to you. And what we do in our meetings, we'll do a retirement review. So we'll review the account with you on understanding exactly what you're doing, but also do a thorough, holistic review of your plans to help you accomplish whatever that is. If you say, Antonio, I want to retire at this age, then I plan to do this, but eventually I want to take Social Security and I want to live on this kind of amount of money every month, even after inflation, after taxes, because we understand you're retiring at a certain age, that dollar will be devaluing over the years. That dollar may be devalued by the time you take Social Security, and we'll have that conversation as well. What purchasing power will you maintain in retirement is what gives people a lot of concern. There have been articles of people saying that they're not that worried about passing at a young age. They're more worried about not living on enough money or running out of money when they retire. So where their lifestyle is going to significantly change. That's what we're here to help you prevent. So once you click on schedule a meeting with your advisor, and I'm going to show you that where we're all located. I'm in West Texas. I take care of everything west of Abilene, Texas. That includes the Panhandle all the way to El Paso, Texas, and the mountains of of Alpine. So let's say I'm your advisor. Let's say you're looking at Lubbock. You click on the account that you have, whatever that account is. Then you'll see our calendar. So you'll see the dates I'm available this week and also in April and so on. So you'll just pick the day that you prefer to meet. Let's say the 26th, and you pick the day and time that is more beneficial to you. You will get a confirmation email that your meeting has been scheduled, and that is your time to ask us everything you want. We'll also create your retirement plan during that meeting and show you where you stand for retirement. And if we're not there at your specific goal, we'll teach you and educate you what you need to do to eventually get you where you want. So we'll create a very detailed plan for you that includes your pension, that will include your savings, your outside accounts, Social Security, any other events of income and expenses that you're going to have in retirement to really show you realistically where do you stand for retirement. Because again, we are here to give you confidence that the day you retire, that you're going to live on what you need to live on to maintain that lifestyle and live comfortably without concern through your last days of life. So, one other thing I wanted to show you, of course, is very important is the plan resources page. So there's a lot of things you can find here on the main site. Is investing information on the investments, the learning center. We have e-presentations, things that you can learn about, just recordings about the different accounts. But in the plan resources, you're going to see a lot of things. So depending on what you're doing, which account you have, if you haven't seen how the accounts have been updating over the years because the limits have been increasing, things have been happening, click on Get Started. Here's going to show you a PDF flyer that shows you what's going on with the 401k and 457. You may have both accounts, and it's great that you have both because the way I see things, we're planning for the long term with a 401k, and for the 457, we're really probably hedging and planning for maybe something short term or maybe both. So, and a lot of people don't understand the 401k and 457. I'll go into that in our presentation today. But here are a couple of things that have been changing throughout the years as the limits. So people are able to add more to the accounts since the IRS has been changing those limits. What is a special catch-up? What is a regular catch-up contribution? Yes, you can borrow from the accounts. You can do loans in case you need to. But what happens to that loan after you separate service and retire from the state? And I will definitely go into that. So a couple of things you will need to know and get a little bit more education. So, and again, schedule meetings with us. We're here for you every day of the week. So a couple other things I'm big on is, like I mentioned, is the investments. So if you want to learn more about the investment options, you just click right here. So you may be doing all kinds of investments. So you can be choosing a targeted fund. You may be having your account professionally managed. You may have your account managed. Sorry, you may be investing over the Charles Schwab with a brokerage account. But how things function when you're retired, you need to understand that very well. A lot of people say, Antonio, I've been putting money in my account for years. I have no idea what it's doing. So we'll tell you what investments you have, how it works, how it grows, what does it do for you, and we'll educate you on everything else that you have access to. And you'll tell us, Antonio, I understand that I'm doing this way. I like the other way better. We can always change it to something else, or we can give you education on how to change it to something that you feel more comfortable investing that can give you the return that you're looking to accomplish and the money growth you're looking to accomplish for retirement. So that quick little summarization of the portal. This is great because on the portal you can do so much. You can link everything to your account. Once you get access to the portal, you can link your checking accounts, your credit cards, your home mortgage loan, any other loans that you have out there, but also other investment accounts and or retirement accounts. If you have multiple retirement accounts and you don't access those every day, link them to our portal, and through our portal, you'll see every single account that you have. It will tell you the balance, it will tell you the transaction it's doing. If it's an investment, it'll tell you the return it's accomplishing on a day-to-day. So you actually see what the account is doing, even though it's over with Schwab or Merrill Lynch or Edward Jones, wherever you may have your money outside, you'll know what it's doing through our portal. And that service you have access to is at no cost to you. So I'm going to pop over to the presentation that we have for today. And Jennifer, just make sure I am sharing. Can you see the presentation?
No, it's a gray screen.
Okay, perfect.
There we go.
Okay, perfect. So a couple of things people are wondering, when is it a good time to retire? They don't understand based on what Jennifer went over, is the years of service. What is the annuity option that you're looking to accomplish? We understand that annuity isn't be that big benefit that state tax offers. So pensions around the United States are disappearing. So a lot of big companies, even some other companies that have been known for having pensions, they're going away, going straight with a 401k. So you've maybe seen articles about those. Just pensions these days is not going to be very common. So the state tax offers that great state pension. Yes, there are different groups. They're a little bit different overall, but they're a magnificent income form of retirement income once you retire. So, but a couple of things we understand is when you finally retire, and these are the conversations we'll have, is how much will you need when you actually separate service? That is typically one point in time in a retirement. May not actually be the time you actually are fully retired, leave the workforce, because you can retire and go work somewhere else and do something to keep you busy. And I've heard some very funny stories what people want to do after they retire from the state is how much do we really need from that time that we're separate from the state up until we're going to leave the workforce. And from that other point in time, when we leave the workforce from there on, how much do we need from there? Right. So we take into account things that we're going to still pay for: mortgages, kids' college, utilities, living expenses, autos. So how much would we need? Where will the money come from? So we understand it's going to come from a pension. It may come from continuing employment. It's going to come from these accounts as well. It may come from Social Security. So wherever that money is coming from, we need to actually put into if something of a representation that's visual. So you can say, okay, if I continue doing this, all these different form of incomes, this is what I'm accomplishing. And you have a visual representation of actual what the taxation is going to be doing to your money, what is inflation doing to your money throughout that process. Then we start setting a goal. So getting your plan moving. And if you don't have one, don't worry about it. We can always create one any day you want to. So this is something that we specialize in. So that plan is actually getting started. I mean, if you don't ever plan, you may never know what your pension dollar will be worth after 10 years you retire. We'll actually give you a representation of what that will be. So getting that plan started is going to be so the most crucial part is because you can never run if you don't start walking. And it's retiring. So this is the fun part, right? So we're going to retire. For a lot of people, they're nervous to retire. They say, Antonio, this has been my workplace for 25 years, 30 years. I mean, I'm very anxious about retiring and not coming to work anymore. So you hear some pretty awesome stories of when you actually retire. And you got to understand, okay, the 401k has been doing a lot of things while you've been saving, you've been investing, it's been compounding. It's time to either put it aside and not touch it for a couple of years because depending on the account you have, there may be penalties, such as a 401k. That penalty exists up until age of 59 and a half, typically. The 457 has no penalty at any age, so you can withdraw money out of 457 out of that account at any time you want to at any age with no 10% penalty. So it's a wonderful account. So we have to understand what are those kind of doing? Even after we leave the state, how they'll continue to grow, what kind of risk do they involve to continue to outpace inflation? What are they doing for you? When should we withdraw money? Typically, is going to be another big thing. And like Jennifer mentioned, just because you retire, our relationship does not end. It actually continues just like nothing's ever happened. We'll continue having those meetings. You can always reach out to us for questions, continue education at any time you want to at no cost. So that's very important to stay in touch even after you separate from the state of Texas. So looking at expenses of retirement, the big ones are healthcare. So your medical insurance will be probably paid for 100% from the state of Texas, but what about your dependents? So if we're paying about, let's say, $400 a month now for dependent insurance, that may continue into retirement for probably for life. So we have to look at those expenses, what they may be, because over time, as we get older, those healthcare expenses tend to increase over time. The home, right? So the home right now, we may have a mortgage, but the home is an expense if you look at it. So even after you retire, what kind of expenses, the upkeep of the house, do you have to maintain? Where is the money come from? It's going to come from your income from the pension, but that takes away from other things that you need it for, right? So we got to make sure we have set aside income if we're on miscellaneous expenses, if they're unforeseen things in the future. Travel. So people tell me all the time, Antonio, I want to, as soon as I retire, I am getting on a boat, going on a trip. I'm gonna have a good time, or I'll see you next year. I'm going for some travel with family and lots of things. So we had to take into account how much are we spending in travel through a couple of years into retirement. How does that affect our portfolio? What kind of return does our portfolio need to obtain to account for those disbursements that we're doing from the accounts? And inflation. Inflation is going to be huge when it comes to retirement. Why? Because inflation typically averages 1.4 to 3% a year. In the past couple of years, since COVID, it's been averaging almost 4 to 5%. So we've had some pretty high inflation recently. Hopefully it's not going to be the norm, but it's been typically doing about 1.7, 1.6 typically over many, many years in the past. So that's something we need to understand. How is our dollar devaluing in the future? What kind of purchasing power are we going to maintain? Eventually, I have a lot of clients that we're gonna have to withdraw at a specific period in time because typically our dollar is just not worth as much, and you need X money per month, right? Whatever that money is, you need to maintain that lifestyle. So if the pension is not buying you enough, the Social Security is not buying you enough, it doesn't come from somewhere. And if we're not saving enough, we're gonna have a gap in income at some point in time. And again, we're here to prevent that with you and give you the education that you need. Another big one is just budgeting. If you don't have a budget day, we got to start looking at budgeting just to be able to keep track of where those expenses are really coming from. So the big things that we're unforeseen, things that we're planning for on a day-to-day. So if it's many people put off retirement because of we still want to pay for education for kids. So for example, a couple of things we look at the three legs that we just saw before. Where is that guaranteed income coming from? State Texas pension is a great pension, like I mentioned, it replaces a big part of people's income, and that will maintain you for many years. So that's kind of depending on the service that you put in, how much incomes you made throughout your career. We're here to help you maximize it. So during our meetings, we'll ask you, have you bought a service time? We know it may be not that expensive, maybe a little expensive depending on the person, depending on your pay scale as well. But a lot of times we'll get you and we'll kind of show you the numbers. Is it worth it to you to withdraw X amount of money from your pension, your 401k, 457 to buy that year of service? So we got to look at the return of investment as well. So we kind of got to look at that, and we'll give you a very non-biased kind of look at the money and the return. So what kind of how long will it take for you to get back the money that you invested by time? It's one of the things that we tend to do to kind of show you. To me, it's always worth it, but for some people, it's not. So Social Security can be a big one. So Social Security income starts at 62 years old. As you understand it, 62 is typically about a 35% reduction of your benefit versus to where you normally should take it. That could be 66 in a couple of months. It could be 67 for the majority of people these days. So if you wait to 67, that's what 100% of your Social Security will be. You draw it sooner at 66, 65, and so on, it starts getting reduced. You typically do not want to take Social Security if you're still working and you make typically over a certain amount. Because if you make over a certain amount, the Social Security Administration will penalize you. They may even stop your payments to you because you make too much. So, but they will start paying you once you start either you leave the workforce completely or you make below a certain amount of income. So just keep that in mind. Social Security it's a great benefit, but again, that's going to devalue over the years once you start drawing that benefit. A lot of questions people ask me, Antonio, when should I wait to take it? If I'm still stay in the workforce, probably to 70 or 68 or 69. If your Social Security age is 67, you can start drawing at 67 years old at 100% and basically make whatever you want. There's no penalties if you wait to 100% age, which will be typically 67 these days. Some people say, Antonio, I don't want to draw at 67 because I don't want to pay the extra taxes. I don't need the money. I have no reason to take it so soon if I'm still working. Some people want to take the money because they want to reinvest it, pay off debt sooner, life expectancy issues, typically, whatever that may be. So yes, Social Security is going to be a great benefit. We'll have that candid conversation when it's going to be best for you to draw it and give you education on it. Your retirement accounts, 401k, 457. So as you know, the 401k has a 10% penalty, like I mentioned before, you're 59.5. There are certain exceptions to the rule. And some applies to law enforcement, some applies if you stay with your current employer here with the state of Texas to at least age 55. Those rules are called the Rule of 50. That applies to law enforcement only, and the Rule of 55 for non-law enforcement employees. So If you want more education on what the Rule of 50 is or the Rule of 55, you can always schedule a meeting with us or just give us a call. We'll go over with you, but you'll find plenty of information on that on the internet as well, how that works. The 457 contribution account, retirement accounts, like I said, has no penalty of 10%. So to me, it's my favorite account, my go-to account, just because you can separate at any age and not worry about the penalty. You can be 50 years old, 52, it doesn't really matter. So, and here with the 457, you don't have to worry about the Rule of 50 for those law enforcement, or worry about the Rule of 55 for those non-law enforcement. It's just a great account offered to you by the state of Texas. So what happens here is the cost of living over time typically goes up, or it may stay stagnant. It may go down depending on the person, but at certain points in time, we're going to start having to pay for different additional expenses such as healthcare, right? We need in-home care, nursing care, whatever that may be, or we're ill and we need to pay for more out-of-pocket costs for insurance. That may also take a toll on your savings in retirement. So while we're currently starting your career, income is working, increasing over time. We retire, that's the pension is going to be covering a big part of your income. Social Security is going to cover another part. Maybe for some people, it's an excessive amount they may receive from Social Security, so it may be great for many years. But for those who have that gap of income, or may are starting saving very late, or start the career very late, and don't have a lot of prior savings from before, we need to start looking, make sure we maximize that Texa program, and it goes in perfectly, and you're given the right education. You understand the benefits of it and how to maximize it to help you eventually accomplish that goal and give you peace of mind in retirement. Because to me, that's exactly what I do every day. I call myself a financial advisor, but I just give people peace of mind that they're actually doing what they need to do day to day to accomplish their goal. So, how to schedule a meeting? How to set up an account? If you don't have a 401k now, or you don't have a 457 today, you can always set one up through us by scheduling a virtual meeting with us. We'll help you set it up with you. We'll go over the account, explain it. We'll look at how much money you should save. Believe me, I tell people you should save at least 5%, but whatever your budget allows, it's fine to start off. We can always work on increasing over time. We look at what kind of money we should save, right? Or what kind of money you have in your account today. Do you know if you have all pre-tax? Do you have pre-tax and Roth? And if you have both, how much do you have of each, right? When are the appropriate times to draw that kind of money? What tax strategy are you creating for yourself? Or have you discussed with a professional to know what kind of money to withdraw at appropriate times to help you lower your taxable situation in retirement? We'll have those conversations with you. So you can set up the account yourself on the Texa portal at texar.com. You can call your specific customer service department. So the state Texas has their very own customer service department here with Empower. So it's going to be 1-800-634-5091. Or we can go old school and complete a form. So that form, we don't like those forms because they sometimes get lost in the mail. They're not uploaded correctly. But if you like to fill out a form, we can definitely do that as well. So people are getting close to retirement. That's why the purpose you're on this call. It's time to retire, getting close to it. Depending on your age, you may be having the ability to save a little bit more into your account. So a 401k and a 457 both have their age 50 catch-up rule. The 457 only has a special catch-up. So what it means is if you turn 50 years old, the normal limit of $23,000 a year that you can save into each account goes up to $30,500 in each account. So you can save $61,000 between both. And there's separate limits from your IRAs and everything else you have outside. The special catch-up rule is a little bit different since it only applies to the 457. And what it does is it can increase your contribution twice as much of the normal limit, which is $23,000. So on a special catch-up, it is $46,000 a year, but you can only do it 3 years prior to retirement. Example: let's say you're going to retire in 2030. That is your normal retirement age. You can do it in the year 2027, 2028, and 2029. You cannot do it in the year 2030. So those 3 years before you retire, you can do that special catch-up and add up to $46,000 into your account through contributions from your paycheck or lump sums. A lot of you are eligible to receive that lump sum from your vacation hours, the annual leave hours you get paid out, because as Jennifer mentioned, it pays out towards increasing your time with the state, but also you receive it in cash. from your agency. The question is how to receive the money. Do you want it to go to you directly? You're going to get taxed on all of it. Whatever that lump sum is, it will be several $1,000s. That will increase your taxable liability for that year when you retire. People say, Antonio, I don't want to pay taxes on the money. I want it just to go into my 457. It comes into your account tax deferred. So it's a pre-tax contribution. And you take it out whenever you want and pay taxes whenever you want to. You can take it out little by little, or you can wait years to take it out. So that is kind of the benefit of the special catch-up. It helps you save very well in the last couple of years, but also receive the very large deposits of contributions or lump sums that you don't want to pay off the year you retire. So kind of I went over one little thing already. Giving that account a boost is make sure that we're maximizing their 401k as much as we can. The 457 accounts, rolling over lump sums. Also, you can roll over old accounts into your accounts here. Let's say you have an old 401k IRA that you forgot about somewhere else and you have no idea what it's doing, or you're not sure if it's really making you money. Let us know. We'll review the account with you, kind of see if the benefit to you. So we'll be fiduciaries in this situation. We'll let you know if it's in your best interest to bring here or not. If it is your best interest, we'll let you know the benefits and so on. A lot of people say, "Oh, Antonio, I have a 401k elsewhere. It's not growing." We'll just say, "Well, what is it doing there? How are you making that account grow? Possibly that money can come here, make it grow here, but also buy you stay time, increase that guaranteed income for the rest of your life from the ERS." So, and there are a lot of things we can go from there, but there's just a couple of examples of things that we go over with day to day with your state employees. So here's kind of a timeline how things function. So age 50, catch up time begins. Your limits increase. The typical rule of 59 and a half when penalties goes away. But also the 59 and a half is when Roth money gains have become tax free. So people want to understand what is Roth, Antonio. Like they're typically it's a different account. On a 401k 457, it's not two different accounts, it's one account. You can add pre-tax and Roth to the 401k and also the 457. But as people know, Roth money, as you putting it into your account, that money has already been taxed. So that money you have put in that is Roth into your account, in your 401k or 457, will always be tax-free to you whenever you withdraw it. The gains, basically the profits of what you made on your investments become tax-free at 59 and a half. So if you withdraw before 59 and a half, that's when you pay taxes on just the gains, not your actual principal or your contribution amounts. Then there's age 62 for Social Security. We're drawing it sooner. People draw it early for many reasons. One, because they want the money. They want to do other things with it, investments or pay off debt or life expectancy and many other reasons. Age 65 is Medicare age. We started looking, a lot of people wait till 65 for Medicare. So that Medicare cost comes out of Social Security at that point in time. Then 66, 67 is going to be typically your 100% rule for Social Security. So it depends on your date of birth. And required minimum distributions. Required minimum distribution only applies to pre-tax holdings in your account. So money that you've been deferring for many years and it's been growing, compounding for you. At a certain age, right now it can be 73, can be 74, 75, depending on your date of birth, the IRS will let you know what age you are needed to start withdrawing from your accounts, your pre-tax accounts. And they'll send you a letter, a physical letter to your house. They'll let you know that you just go withdraw 4%, 5% of your account balance wherever you have the money, and that suffices your RMD. They will tax you, and that's all. They will not call you, and I mean the IRS will not call you. They will not text you. They only send official letters. Just be wary. There's a lot of scams going on with these kind of things. So you withdraw, you're taxed. You can do whatever you want with money. You can reinvest it in something else if you want to, or you can go spend it or save it. RMDs, like I mentioned, only applies to pre-tax. It does not apply to Roth money. Why? Roth money is tax-free and not subject to this rule. So a couple of things that we'd like to go over with you is making sure that setting up a time with us. Like I mentioned, you have advisors throughout the state. There are right now there's 6 of us. There's 7 of us. We're working on one more, and I'll show you a map of who we are, where we're located. So setting up a meeting with us. When you set up that retirement review with us, that confirmation lets you know what you to bring a Social Security statement with you. It will have the link to go to the Social Security website to access that and set up your account. bring statement from ERS, bring statement or your most recent paycheck stub, so we can give you very realistic numbers on where you stand for retirement. So getting an estimate what your expenses are. So we actually will really go down on that and say, how much do we really need? What are your expenses that you need to bring home? How much do you need to participate in that income of the household? You'll be bringing some money home. Your spouse maybe also bring some money home if there's a spouse, and so on, right? But the big thing is, Antonio, I need to understand how to take money out of my account. People just don't understand those withdrawal strategies, because we'll show you a proper withdrawal strategy to make your money last up until life expectancy to maintain that lifestyle. But people sometimes just don't have any idea how to do it properly. They withdraw too much or they withdraw too little, and that may cause problems for them in retirement. They have too much money, they're causing too much taxation issues, or they're not taking enough, and that may cause an issue as well. So I'll help you create a plan on how to take money out appropriately out of the accounts, and also show you what kind of risk that account needs to maintain if any other investments are recommended for you while you're retired. We'll also advise you to go seek advice from a tax advisor to make sure you're taking advantage of everything outside when it comes to taxation to help you pay less taxes. So that's basically what we all do is we pay our taxes, but we want to try to keep as much as we can, right? Contribute as much as you can to your account. So curious, if you ask me how much, if you should contribute more, the answer is always going to be yes. So I tell people, you always want to be ready for the unknown. And one thing you can control is how you save, right? How you invest the money and make sure it's in the right account. So always save a little bit more. It always going to help you in the long run, right? And also review your investments. If you don't know what your investments are, if you haven't reviewed those in years, please schedule a meeting with one of us. We'll always take the time, educate you what you have and everything else you have available, because there's so many cool things you have available and how to invest your money. So we want you to make money. We want you to grow your account very well. But sometimes it just takes a call, takes a quick little 30-minute meeting, 45 minutes to really create a proper strategy, understand your options, and go from there. So distributions, they're very simple. So if you're retiring, let's say here at the end of this year, what happens is once we're notified of your termination of separation from the state, you retire from ERS, we'll send you a package. You typically get that package in about 30 days after your last day of employment, and that package comes from Empower. That package will have all the information for you to start with receiving withdrawals. And you can set up those withdrawals to be recurring, such as every month, every quarter, twice a year, once a year. And you specify the date, you specify the frequency, and you also specify the amount. We're not going to tell you how much you're going to get. You're going to tell us how much you want and how often. You can choose to withdraw just whenever you want to. We call those partial withdrawals. Basically, I like to call them willy-nilly withdrawals. Just basically whenever you want to. But also, you can take the whole account out if you wanted to. If you already have a well-established relationship with another advisor somewhere else, and you're looking to invest in a different manner, or look at buying an annuity, or doing something else with the money entirely, you can just basically do a full lump sum withdrawal. Careful with those. If you take all of the money out and it gets paid to you and it's pre-tax, you will be getting a pretty hefty tax bill from the IRS. Hence, why I'm a big fan of Roth holdings in the accounts. So distributions can also be done through that paper document that you receive from Empower. You can do those on the phone with customer service, or you can do those through the portal at texaver.com. One cool thing I tell people is you can always stop in case you don't need the money anymore, because people typically withdraw for a couple of years up until they start drawing Social Security. When Social Security kicks in and they start receiving that income, they stop taking money out of the account because they don't need the extra money. They don't want to pay the extra taxes, and basically they don't need it. But eventually we're going to have to start again, right? But typically it's 74, 75 years old these days. So, and like I mentioned, just because you separate service doesn't mean it's goodbye. One of the cool things about the Texera account offered by the state of Texas is these are extremely low cost accounts. Investment options offered to you are great. These are great funds. The state of Texas has a committee that vets them all the time, make sure they're quality, great cost on the funds, very well diversified. The state of Texas takes great time and care in making sure they offer you great funds to you. You can always bring more money in I have a lot of people saying, Antonio, I've loved my 401k for years. I'm going to bring in on my other account. I'm bringing my IRA. Just keep it all in one place because one, customer service has the customer service from Empower is, I mean, bar none, one of the best in the industry. So we take care of clients very well, and we take our time making sure we understand things also very well. Also, for a lot of you, you may not be managing your money. You may have your account actually actively managed by a team of asset managers here. So if you have that managed account service turned on and someone managing your money for you, that account is a very low cost. Typically, from a professional managed account, you'll pay anywhere from 1 to 2%, typically 1.3, 1.7% a year for an actively managed account that's done professionally. Here, it's very cheap. It's 0.35 a year. So if you're going to roll your money out to another firm, you're going to be prepared to pay more money somewhere else. So people typically keep the accounts here because the accounts are very well managed. You have great customer service. You meet with your advisor every year or as often as you like. So that's typically one great thing that we do. And also, we'll be giving you updated spend down strategies every time that you meet with us. So customer service, like I said, is great service. I mean, please save their number. I tell people, save the number on your phone in case you have a question. And we're closed due to operation hours here, like here at our retirement plan advisors. We're typically open from 8 to 5 at your time zone. I answer my phone all the time, all different hours of the day, so you can call me anytime. But customer service is there from 7 to 9, Monday through Friday, Central Time, and 8 to 4:30 Central Time. A lot of things you can do on your own through the website. You can do loans if you want to do a loan through the website. You can do withdrawals from the website. You can do loans and withdrawals from the customer service. We, as retirement plan advisors, will give you education on the loans, but we don't process those for you. Just keep in mind that. So there's some pretty good information out there for the Social Security Administration, Medicare, and the IRS. One additional thing I tell people is if you're going to be creating your beneficiary form the way you want it to, and you have a trust, or you're going to have an estate, or there's something different that you want to do, make sure that trust or that estate is the primary beneficiary, and we follow the directions you want. If you don't have one, you don't have a trust, you don't have an estate, and you're thinking of getting one, go talk to your attorney. I'm not sure the state says offers legal advice services, but they do. That's a great benefit to have, and that's something you should probably look at enrolling here as open enrollment. But sitting down with a good attorney, making sure your wishes are handled the way you want if you pass away. They may also help reduce the tax burden on some of your beneficiaries. So seek some advice, but please check your portal. Go on your portal and see your beneficiaries are there. If they're not, go on the portal and get that form and submit it to us as soon as you can. You can submit the beneficiary form right through the Texa portal as well. On the change of address, at the moment, it can only be done through ERS, but once you separate service and you're retired, you can definitely change your address right through our portal as well. So here's a quick map, all the advisors. So myself, I'm handling the Panhandle of West Texas. Mike McClellan, he's out there in Little East Texas, Dallas, by Oklahoma. We currently have 2 advisors in Austin. So it's Nick Fry and Danny Jensen. In Houston area, Texas, so like Beaumont, Shreveport, and all that, you're going to have Daryl Goosby. And currently, for example, I'm no longer covering the South Texas, which is San Antonio RGV. That region is now being covered by Francisco Hernandez. So Francisco, one of our new advisors, he finished his training just a few months ago, but he's very capable to service any of your questions or concerns you may have. So please reach out to Francisco. He's actually looking on our portal as well. So I'm going to take a quick questions. And does anyone have any questions for me that they'd like to go over before I finish up today?
No, I don't see any questions. If you have any questions for Antonio or for us, make sure to type those in the Q&A and we'll get to those questions.
A lot of those who don't know, I've not gone to the portal and they're not very portal savvy, like myself. Download the app. So there is an app on your Apple Store or the Google Play Store. Type in Empower Retirement. That's going to be a white and red app. It looks like a flag. Download it and you can register on your phone. You can do things on your phone. The only thing you cannot do on your phone, though, is change your contribution. But you can do almost many other things right through there. So please double check your account. That way you can see your account balance on the day-to-day if you want to. I don't recommend it. It will drive you nuts. But yes, make sure you have access to your account. It's going to be very important. That way you can look at your portfolio, what it's doing. Great. So if you have any questions, please let me know. And if not, it's been a pleasure being on today's call.
All right, thank you, Antonio. It's a lot of really good information that I think is so important for everybody to think about. Can they actually afford to retire and schedule those appointments? They're no cost. So another great benefit of working for the state, you get access to Antonio and our other RPAs or retirement plan advisors. Y'all are all financial advisors, right? Certified, Antonio?
Yes, we're fully licensed financial advisors.
Yeah, so I mean, that's a great benefit, having access to them without having to pay anything additional. Take advantage of that. All right, thank you, Antonio. I'm going to go ahead and share our website so I can show you where to find some information. So first, this is our website, ers.texas.gov. So first thing, I mentioned the ERS online account a few times. This is where you can find that brown button there, My Account Login. That is where you would go if you haven't already registered. You can register or you can log in. We get the question a lot, I locked myself out, or can you reset my password? You do have to call to get your password reset, but make sure you do that so you can do your retirement estimate, update your beneficiaries, update your contact information. That's where you would go to do that. If you scroll down on the page, we have our What's Happening Now section. We keep all of our latest information. If you are part of Group 4, we have a video that was made in English and in Spanish just for Group 4 employees. And then we have the latest links to our webinar, prescription drug information. If you scroll down a little bit more under benefit programs, we have the links to all the different websites. So I said, if you can't remember, if you search Blue Cross and Blue Shield, you'll find all kinds of websites, I'm sure. But you can find the actual links that take you right to where you need to go to find more about our specific programs, including Texas Saver, where Antonio just was. If you can't remember where to go, it's texassaver.com, but you can go to ers.texas.gov to get to that website where Antonio was just talking about. I log in all the time. That's where you can create your appointment. You can view all of the different important program news, different publications. It's a really good website to go to. If you go to the Blue Cross Blue Shield website and go to wellness here on the side, there's different programs, but there's the fitness program, tobacco cessation, weight management program. If you go to fitness, that shows you there's different packages you could sign up for. I said I go to Lifetime, a really fancy gym, and it's more than this, but I signed up for the bus package so that I could have access to that gym. And you can sign up for any of these, and then you have access to thousands of gyms. If you're traveling, you can find a fitness center. So this is where you would go to sign up. What do you do after you sign up? When you sign up, it'll give you a little card to download. It says this is your fitness program access card, and it has a number on there, and like membership number, kind of looks like a credit card number. And you just take that to the gym and show it to them, and they just get you in the system. So that's where you go to find that. But on this page, you could also find a doctor or a hospital. You can find more information about specific plans. If you want to know about a specific kind of service, you can go through there. If you don't know about virtual visits, that's a great benefit. You can have no cost virtual visits through Doctor on Demand or MD Live. There's also mental health virtual visits. And I have that app. I've used Doctor on Demand so many times. It's great, when you're at home and you can create that appointment, and it's covered 100% if you're enrolled in Health Select of Texas or Health Select out of state or Health Select secondary. So check that out. I'm going to go back to our home page, and I wanted to show, I mentioned the discount purchase program. That's here also under benefit programs. All the links are here. This is how you get there. And that's where you would go to create a login and password. Okay, so I mentioned presentations and our events calendar. I want to show you our full events calendar and show you where to find the presentations and the webinars. So we have this link here, presentations and videos. That's where you can find all of them all in one place. But if you want to know about our Medicare preparation sessions, you can click there. We have one coming up tomorrow, actually, at 12 p.m. And we have the video, the PDF, we have a handout for preparing for Medicare. So you can join that. You can also watch the video on our YouTube channel. Now, if you want to find our YouTube channel on any page, if you scroll down to the very bottom of the page, right here is the icon for YouTube. If you click on that, that'll take you right to our YouTube channel. And that is where you can find presentations. And we have all of these videos here. So I'm going to go back here. We get the question a lot, if you don't qualify, if you don't get the 100% contribution, how can you find out how much you'll pay for the premiums? And if you go here to premium rates and you go to retirees, if you don't qualify for 100% of the state contribution, you're going to look at the tiered rate sheets over here. So whether you're eligible for Medicare or not eligible for Medicare will determine which rate sheet. But I'll just look at the one eligible for Medicare. And it looks like a lot, but the way that you would look at this, you would see what amount you fall under. So if you are going to get 50% paid by the state, you would be in this over here in this column. Then you would look to see which plan, so Health Select of Texas, if you're not yet enrolled in Medicare, or if you are enrolled in Medicare, you'd look at the Health Select Medicare Advantage or Secondary if you wanted that one, which is, I think, Health Select of Texas. But if Medicare Advantage, you can just see the difference. So if it's only you or if it's you and a spouse, you can see the difference on those depending on what you qualify for. I'll show you again how to get to that. I'll go back to the homepage, ers.texas.gov. If you scroll down under premium rates, that is going to be over here. And that's the rate sheets. We also have a health plan comparison chart. So some people ask us, which plan they should sign up for, and you can look at those. We also have a dental plan comparison chart, vision comparison chart. So that's where you can find that information. Okay, perfect. If you do have any questions, you can always call us, or if you have any questions about the presentation, you can email us at presentation.questions@ers.texas.gov. And we want to thank you for joining us today to learn more about your retirement. So we hope you have a good rest of your day.